China's GDP numbers still look strong on paper, but incomes are collapsing. So why is it that the more Beijing invests, the poorer Chinese people get? What's really behind China's brewing fiscal crisis? Welcome back to Final War with Katherine Hu. If you've been following China closely, you've probably had this nagging question. How is it that China's economy is still growing, yet life for ordinary people keeps getting worse? Today, we break down the real root of China's fiscal crisis. Why does GDP keep rising? Government spending keep climbing, while the people get poorer. Is China facing a fiscal crisis? In my view, absolutely, but not in the way most people think. The real issue isn't just how much money the Chinese government is spending or borrowing. It's how fast they're doing it, and more importantly, what they're spending it on. Let's start with speed. On July 15th, China's National Bureau of Statistics released its second quarter numbers. GDP grew 5.2% year over year, slightly slower than Q1. For the first half of 2025, total GDP growth reached 5.3%, above the official target of around 5%. Let's compare China's 2025 numbers with global benchmarks from 2024. Canada's GDP growth, 2.2%. United States, 2.9%. Japan, a mere 0.1%. South Korea, 2%. Taiwan, 4.4%. Only Taiwan comes close to China's reported 5.3%. So on paper, China looks like a global outperformer. But here's the puzzle. If growth is strong, why do ordinary Chinese feel like they're worse off than 5 years ago? Compared to past years, China's GDP growth hasn't fallen that much. In 2019, growth was 6.1%, just 0.8 percentage points higher than the 5.3% reported for the first half of 2025. But anyone, anywhere, can see the difference. Back in 2019, life in China felt entirely different. Stronger consumer confidence, better job security, more optimism. So if we're saying China's GDP data is fake today, are we claiming it was real in 2019? Of course not. The numbers were likely inflated then too. But here's the point. Even with all the fudging, that 0.8% gap between 6.1 and 5.3 has produced a massive decline in lived experience. And that's not just anecdotal. Goldman Sachs just backed it up. Goldman Sachs reported on July 21st that real wage growth in China for Q2 was just 3.9%, the lowest since the pandemic began. Slow wage growth means weaker consumer spending, and that drags down the entire economy. So here's the question. If GDP is rising, why are people's incomes stagnating or even falling? Let's look at where China's GDP growth is actually going. In any normal economy, GDP gains are shared between the government and the people. But under the Chinese Communist Party, that balance is broken. On average, Chinese citizens only receive about 40% of the national GDP. In the US and Canada, it's over 70%. The global average? Around 60%. But even setting aside the unfair split, there's a deeper problem. In theory, if GDP rises by 5%, then incomes, government spending, and overall output should each rise about 5%. That would be a healthy, balanced growth model. But what if the government spending is growing at 10%, while GDP is only growing at 5%? That means the state is absorbing all the growth and more. That's exactly what's happening in China right now. Beijing's spending is crowding out the entire economy. Let's do the math. Let's assume China's official 2025 GDP growth target of 5% is accurate. With a 2024 GDP base of 135 trillion yuan, that gives us 6.7 trillion yuan in new economic output this year. Now let's look at government spending based on China's own 2025 budget. There are three major spending categories. 1. General public budget, 29.7 trillion yuan, up 4.4%. 2. Government fund budget, 12.48 trillion yuan, up 23.1%. 3. Additional debt-based spending. The general budget increase of 4.4% means Beijing will spend 1.3 trillion yuan more this year. The fund budget increase adds another 2.4 trillion in new spending. Combined, that's 3.7 trillion yuan in additional government spending. Now compare that to the 6.7 trillion in total GDP growth. Over 55% of that growth is immediately consumed by public spending. And that's not all. Beijing's official debt ceiling just rose from 82.1 trillion in 2024 to 99.9 trillion in 2025. That's nearly 100 trillion yuan in debt, up 21.6% year over year. Now, debt overlaps with budget spending, so we won't double count it. But it makes one thing clear: the state is outspending the economy by a wide margin. And if you factor in widespread skepticism over China's GDP numbers, most analysts believe real GDP growth is closer to 2.5%, not 5%. That would mean only 3.4 trillion yuan in real economic gains this year, less than the increase in government spending. Let's rewind to 2019. That year, China's GDP grew by 7.1 trillion yuan compared to 2018. Meanwhile, the combined increase in general and fund budgets was just 2.7 trillion, about 38% of GDP growth. Even if we assume half of that 7.1 trillion was inflated, there'd still be 3.55 trillion yuan in real economic expansion. That's more than the government's increased spending. Now you can see why a small numerical difference, 6.1% versus 5.3%, feels like a giant chasm in real life. And let's not forget, this year, Beijing also expanded its debt ceiling by 18 trillion yuan in a single year. That's almost triple the size of total GDP growth. Yes, some of that debt overlaps with budgeted spending. And yes, debt math is a bit more complex. But still, the message is clear. Government spending is exploding and it's swallowing the economy whole. Beyond the raw numbers, the case studies speak for themselves. Early this year, Beijing launched a trillion yuan national subsidy blitz, handing out consumer rebates across the country. Then came the Yalong Changpo hydropower project, another giant state-led investment with a budget of 1.2 trillion yuan. But here's the strange part. The slower China's economy gets, the more aggressively the government spends. And that kind of spending, it's not saving the economy, it's draining it. Let's say China really does hit 5% GDP growth this year. Under current conditions, nearly all of that growth is being absorbed by government spending. So who actually benefits? Government officials, public sector workers, companies and projects that survive on subsidies. Ordinary people? They're left behind. So let's recap the first major problem. Beijing is spending too much, too fast. And the second, even deeper issue. It's spending money on the wrong things. In theory, government spending should create value. You spend 100 yuan and generate more than 100 yuan in GDP, but under the Beijing regime, that equation no longer works. Where's the money going? Massive government payrolls, bloated bureaucracy, corruption and waste, and then there's investment. For decades, China's government was the driving force behind infrastructure investment. From mega projects like the Hong Kong-Zhuhai-Macau Bridge, the Three Gorges Dam, and the Xiong'an New Area, to a nationwide web of bullet train stations, expressways, and urban roads. These were massive spending zones, rife with waste and corruption. But at least in the past, the speed and efficiency of Chinese infrastructure did provide some economic momentum. Not anymore. Just look at Xiong'an, a political showpiece that now stands unfinished, or the Macau Bridge, built at enormous cost with underwhelming returns. So Beijing shifted focus. They began pouring money into high-tech sectors, what they call the new three: electric vehicles, solar panels, and batteries. And yes, some results followed. China's EVs are cheap and their exports are rising. Beijing even dreams of dominating the global EV market. But here's the reality. Most of these new three companies are losing money. The sector is plagued by overcapacity. And now, China is flooding foreign markets, triggering US-China trade clashes and a new wave of EU-China tensions. So even these high-tech investments have failed to deliver real returns. What did Beijing do next? Consumer stimulus, more rebates, more cash injections. And once again, same story. The few sectors that got direct subsidies saw a temporary bump. The rest of the economy still stagnating. So now, it's back to the old playbook. Big infrastructure again. This time in the remote mountains of Tibet, the Yarlung Tsangpo Dam. But here's the problem. China already has too much infrastructure and too much solar power. The country isn't short on electricity. This isn't about supply, it's about finding a reason to keep spending. At this point, Beijing isn't investing. It's bleeding funds just to keep people employed. Here's the real crisis. On one hand, Beijing is spending too much, which squeezes out real growth and leaves citizens poorer. On the other hand, they've run out of places worth spending on. The system is out of ideas. And like a cornered animal, it keeps repeating the same trick. More spending, more investment, more failure. Even if GDP somehow hits 5%, the people won't feel it, because every percentage point is swallowed by the state. The more Beijing chases growth, the worse life gets for ordinary Chinese. This is the paradox. In today's China, the more the CCP tries to hit its GDP targets, the more it hurts its own people. Nomura once put it perfectly. The only time Chinese citizens will truly feel relief is when Beijing stops obsessing over GDP numbers, because growth isn't the point. How that growth is achieved, that's what matters. You might be wondering, can't the Chinese government just stop spending? The truth is, they can't. And the reason isn't economic, it's psychological and political. This isn't about national confidence. It's about the party's confidence in itself. There are two core reasons. One, the system itself is expensive. China's bureaucratic machinery is massive, and just keeping it running eats up enormous funds. Two, spending is the core of the CCP's so-called institutional advantage. In an authoritarian, centrally controlled state, Beijing constantly claims that it can mobilize resources better than democracies. But take away massive investment, shut off the government tap, then the CCP is forced to admit its model isn't actually superior. That's why they can't stop. And that's why, if we step back and look at the big picture, China's fiscal system isn't collapsing from lack of money. It's facing internal breakdown, burning cash. This is no longer a budget problem. It's a broken model. And at this point, no matter how much the CCP spends, it simply can't buy real growth anymore. Do you agree with this analysis? Let me know your thoughts in the comments below. Get the real story behind the CCP's shifting power games and see where US-China relations are headed next. Support the vision of a new China without communism. Subscribe now and join us in bringing the truth to light.